We've all heard that famous quote, guys. Investing is a game of finance with a few properties in between. Welcome back to another video where we're going to talk about the boring stuff today. We're going to do a surface level touch on lending and different strategies and their different uses. The agenda for today is we're going to look at lending criteria, what lenders look at, portfolio growth considerations, some common mistakes and risks, and I'll touch on some of my own personal experiences throughout my investing journey. Firstly, how are we assessed? How are you assessed? How am I assessed? How is all of us assessed by the banks? Well, there's a couple of ways. We all need to have an income. We're either PAYG, we're working for someone else. We're either self-employed, in which case banks generally want 2 years worth of financials. Some banks will take 1 year, but generally it's 2. Other income factors that banks will look at is our rental income and other forms of dividends, depending on the lender as well. They also look at our current and existing debts, mortgages, investment loans, car loans, credit cards, student loans. Loan to value ratios of our principal place of residence and or our investment properties. Living expenses and credit histories are all the sort of things that lenders look at when they're assessing us making a credit claim. A couple of strategies I like to look at a surface level without diving in too deep, and I'll caveat this by saying I'm not touching on trust lending in this video. That needs a whole video in itself, and we're all aware by now, I'm assuming, that a lot of banks have stopped or paused trust lending. So the buy and hold strategy is typically done by people purchasing investments or principal place of residence in set and forget areas, which I'll touch on, and they're typically paid off with principal and interest loans. It can be interest only, but generally principal and interest. They're bought in areas with a horizon, long-term capital growth horizon in mind, and they work well, like I touched on earlier, in low to medium risk markets and stable economies that are both diverse and have a large population. Something very important in a buy and hold strategy. No point buying in a mining town of a sub 5,000 population and leaving it as a set and forget. You will be burnt and bitterly disappointed. Interest only loans is another common strategy, I guess, that a lot of investors employ, myself included. So interest-only loans can only be repaid monthly to the bank, and you are only paying off the interest component of that loan. You are not paying off the principal, so the loan amount will not change. The maximum term of an interest-only loan generally is 5 years. You can refinance again for another 5 years, depending on your circumstance, your borrowing capacity, and your LVR, but generally the initial period is 5-year term. Why would you use interest-only loans? Well, it improves your cash flow. You're only paying off the interest component, allowing you, during your accumulation phase, to accumulate properties faster. Like I said, it's very common for investors. It has a lot of its tax advantages as well. But interest-only loans are highly scrutinized by lenders, guys. More scrutinized than principal and interest, because in the bank's eyes, you are just paying off the interest portion. You're not actually paying off any of the principal of the assets. Equity release and extraction. Something that a lot of us investors employ in our strategy, in our portfolios. So it's very common with investors. It gives you access to funds using the bank's money or other people's money, if you will. You're releasing equity and using it to continue to accumulate. Equity is the difference between the property value and the remaining loan amount. For example, if your property is worth 500,000 and the loan is 250, you have an equity amount of 250,000. Bear in mind, most banks will only give you 80%, up to 80% of the value of the asset. You won't be able to withdraw the whole 250,000 in the example I've given. Why would you use equity extraction strategy? Well, it allows for quick accumulation. If you had to save a deposit for every purchase, you'll be waiting a long time, depending on your income and your situation, to continue to accumulate. Why I love this strategy is because you're basically using the market's money, other people's money, against secured by your own property to be able to continue to accumulate in your portfolio journey. One thing to remember, guys, equity is debt. It is not free money. Equity, in my opinion, should only be used to continue to invest in property or any other asset class, but in this case property, because that's what will give you your tax benefits and your tax breaks. If I pulled out $100,000 equity and bought a Ferrari, I would not be able to claim any of that back on tax, the interest component of that loan. Guys, I can't stress this enough. I've made this mistake when I started in my property investing days. I cross-collateralized a couple of properties as security for a single loan. why you should not do this. Some of those reasons: it's high risk and the banks have more control over your portfolio. You lose flexibility as an investor. If you have 2 or 3 properties tied together by a loan and you go to sell a property, it's going to get messy. You may have to cough up more money to bring another asset value up to 80% LVR. Avoid it at all costs, guys. If there are situations that I know of where if one of the assets in your portfolio that's linked to other assets through a loan drops in value, well, the bank may require you to bring that LVR of that portfolio back up to 80%, thus costing you either cash out of your pocket or equity, which you may use, which you would have otherwise used to purchase another asset. Guys, assets, I look at assets in a portfolio as like employees. Now, you can use your employees for 2 main reasons: capital growth and cash flow. Capital growth assets are purchased in good locations and they give you that growth to allow you to extract that equity and to keep accumulating. Cash flow assets give you cash flow to keep you in the game longer. Property investing is about how long you can hold, amongst other strategies, but that is one of the main strategies. There is no point purchasing a couple of assets that have high capital growth but are bleeding you dry on a month-to-month, year-to-year basis. Realistically, how many of those assets can you hold? Maybe 1, maybe 2, maybe 3, then you're tapped out. A couple of the risk serviceability and risk mitigation strategies that I like to recommend to clients is: number 1, nothing in life is risk-free. Nothing. Everything we do in life, from investing to getting in a car to catching a flight, all has an element of risk to it. But there are things that we can do to reduce and mitigate that risk. Number 1, cash buffers. Very important, guys, for each property is to have a cash buffer. Things go wrong. Tenants leave. Vacancy periods. Hot water systems. Carpet needs changing. What did I have the other day? I had one asset that had all 3 air conditioners go down and needed servicing. If I didn't have the cash buffers in place, well, I may have caused me distress, but the cash buffer was there. Bang, take it out of there, fix the air cons, and off we go. Another thing that people overlook is to maintain a cash buffer for living expenses. The minimum I recommend clients is between 3 to 6 months worth of living costs. That way, if something happens, you're laid off, you have an injury, you break your leg, you have money there to allow you to keep living, pay your bills, maintain your lifestyle, and not have to sell off assets. And the last point I like to remind people is to use multiple lenders. I advise all my clients to use multiple lenders and not give one lender entire control of my portfolio. A couple of common mistakes that I see that I made myself and that I see or investors from that range and all levels of experience do is over leveraging too early. That's a big one. That's one that young, keen investors, young in the investing game, tend to often do. They over leverage too early. They lose that sleep at night factor, and if anything was to go wrong, if values don't go up the way they thought they would, they start to stress. A couple of vacancies, a couple of issues in the rental property, and all of a sudden you're looking at having to force sell an asset. Not maintaining enough buffers fits in nicely with that as well. Like we touched on previously, guys, buffers is critical to give you that sleep at night factor. Have those cash buffers in place. Whatever goes wrong, you can weather the storm and continue to move forward. Now, the next 2 points tie in with each other nicely: buying in the wrong market and buying at the wrong time of the cycle. Guys, if you buy in the wrong market, you will not get capital growth. You may even go backwards. If you follow the hype and you buy at the wrong time of the cycle, investors may pull their money out. Buyers agents propping up that area may pull their money out. All of a sudden, you've paid premium for a property that is either at best going to stagnate, at worst going to decline in value. It's akin to being dropped off at near the peak of a mountain. You're a mountain climber. You've been dropped off by a helicopter to the peak of a mountain. You haven't enjoyed the ride up, and all of a sudden you're at the peak. You've missed the whole experience. You've missed the whole journey, and now you have to try and get back down. And the last error, like I touched on, is cross-collateralizing properties. If a broker advises you to do that, run the other way. I'd like to finish this with a couple of key takeaways, guys. For every purchase that you make, don't just look at that purchase. Broaden your horizon. Think, okay, this property I'm purchasing now, how is it going to get me into the next asset? How will this asset, what's its role? What's this employee's role? Is it a cash flow or is it a capital growth asset? Use lenders and structure strategically. Like I touched on, I wasn't going to touch on trust lending in this video. That needs its own separate video. But use lenders strategically. A good broker will allow you to pull different levers with different lenders in different periods of your life and your investing journey, and you can use lenders and the bank's money strategically. Build the right team around you, guys. You'll see this quote or similar quotes getting thrashed by buyers agents all over YouTube, but it is true to a point. Build the right team. I'm not suggesting using my services. I'm not trying to sell you a course, but make sure you have the right broker in your repertoire, in your arsenal. Make sure you have the right, if you want to use a buyer's agent, make sure you have the right buyer's agent. Make sure you have the right accountant. These guys are going to be the make and break of your property journey, of your property portfolio. And finally, guys, as tempting as it is, we are all human. Don't follow the herd. Don't follow the hype. If an area is on the media, it's too late. If a buyer's agent is propping up an area, know for sure that they've already been buying in that area for the last 6 to 12 months, and now they're trying to build up the hype and get the rest of the herd in that area to lift the demand of that area, lift the prices up, and then they can tell their clients, well, we've got your XYZ growth, sign up with us again, pay another $25,000, and we'll find you another property. Guys, property investing is a beautiful journey. It has its ups, it has its downs, but in the long run, you're building wealth for your family, for yourself. You're using the bank's money. You're letting inflation do the work for you. Inflation every year cheapens the amount of money that's in circulation, requiring more dollars to buy an asset in your area, thus increasing the asset price, increasing your wealth, and hopefully giving you and your family a better life. Guys, I hope you enjoyed this sort of video. It's a bit longer than I anticipated, but we could talk for hours on every one of these points. If you like this sort of content, please let me know, and I'll do some more deep dives into certain strategies and certain lending techniques. Till the next one, guys, take care. Thank you.